Ladies and gentlemen, good day and welcome to the Gateway Distriparks Limited Q1 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. Today on the call we have Mr. Prem Kishan Das Gupta, Chairman and Managing Director, Mr. Ishan Gupta, Joint Managing Director, Mr. Samvid Gupta, Joint Managing Director, Mr. Sachin Bhanushali, CEO, Rail, Mr. Sandeep Shaw, Chief Financial Officer, Mr. Manoj Singh, President, CFS. I now hand the conference over to Mr. Prem Kishan Das Gupta. Thank you, and over to you, sir.
Thank you. Good evening and a warm welcome to all the participants to the post-results earnings call of Gateway Distriparks. We have uploaded our results, press release and presentation on stock exchanges as well as company website. I hope you had an opportunity to go through the same. The format that you find this time in Q1 2023 results, some of you might feel it is different, but basically after the merger, everything is now consolidated into one company, which is Gateway Distriparks Limited, except for a subsidiary which is Gateway Distriparks Kerala and an associate company, Snowman. So going forward, we will be carrying on with the same format because there is no point in giving Rail, CFS, MP, both at Rail and CFS because the company is one, and the purpose of having the company merging was that we have combined revenues, we have combined efficiencies, we have combined costs, which have come down quite a bit, after our merger. And going forward, to give a split between Rail and CFS and MT, and it's one company, one cost, and we cannot spread the cost, over different verticals. And frankly, we are following the leader in this segment, who reports the numbers. And so we will be willing to answer the question where the growth is and where the business is good and what are our plans. But please try and understand that we will not be able to accommodate a request where someone asked, the past split up of the Rail and the CFS business, because this was not the idea when we merged the company. And the company's last quarter, we had some hiccups in the sense that due to COVID situation, Chinese ports shut down, and a little bit was contributed also by the war situation between Ukraine and Russia. But the COVID situation has now been overcome at the Chinese ports, and they are now fully functional, and we can see the containers which were stuck up and the last quarter arriving in July, and new contracts being made between the vendors and suppliers and all over. So we expect healthy growth in this Q2. In July has been exceptionally good. So with that, I will pass on to the question and answer session to the participants. Thank you very much.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. We request the participants to limit their question to two per participant at a time. Should you have more questions, we request you to get back in the question queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhumika Nair from DAM Capital. Please go ahead.
Yeah, good evening, sir. While I understand that there is going to be limited disclosure on the separate businesses, just want to understand the reason for the decline in the EBITDA per TEU on a consolidated basis. If I look at it, it has actually fallen to about 4,900 rupees per TEU versus 5,200 last year and 5,300 in the fourth quarter. Now, I would assume this is largely got to do with the rail business, given that 4Q had already seen a very weak performance on the CFS side. So if, some more qualitative reasons for this decline, has it been because of the impact of the withdrawal of the haulage charges? Has it been, lower empty running and things like that?
Basically, the delay in being able to pass on the haulage charges from Indian Railways to the customers. So that takes about anywhere from a month to 45 days, which depends person to person. Apart from that, it's basically the China lockdown, so that had some impact on volumes. And then just the yearly cost that increased, all the increments with the staff and labor and things like that. So that's what's led to the decline. And also there were some one-time costs, again, related to the merger, which are now pretty much done. We had that event and there was a lot of advertisement, legal fees, merger fees. So that was also still carrying forward in this quarter.
And Bhumika, in addition to that, like I said, we are reporting now the empty handling by CFS business also, which was not being done in the past. So rail was reporting laden and empty, and CFS was only giving a laden throughput. So we have added the empties handled by the CFS business also, which is low yield. So that might impact the overall per TEU realization. But going forward, these numbers, everyone can, this will be the benchmark for how we operate at various levels. And since there will be some, earlier there were some restrictions due to related party transactions. Now, we are operating on pan-India basis, so we have cross-selling between rail and CFS businesses. So
companies for rail transport vis-a-vis road? Is it picking up quarter on quarter or month on month?
Yeah, I missed the first word, but before inquiries, what you said. But we are seeing a shift from road to rail, especially with the DFC as more and more of it gets commissioned. People are valuing the faster turnaround time. So when the DFC comes, we should see an even more shift. And over the last 2 years, I'd say it's made good strides in this.
Okay. Thank you so much. That's it from my side. All the best.
Okay. Thanks.
Thank you. The next question is from the line of Mr. Achal Lohade from JM Financials. Please go ahead.
Yeah, good afternoon, sir. Thank you for the opportunity. My first question was just on the CapEx. Sorry, I didn't understand. You said 250 crores for the two rail terminals. Have I understood it right? Is this only for the rail terminals we are talking about, 250?
Sorry, Achal, we can't hear you properly. Would it be possible for you to move closer to the phone or something?
Just give me a second. Is it better now?
Slightly, but we can try it.
Okay, so my question was with respect to the CapEx. You mentioned that the CapEx number you're revising it to 250 crores. Is that only for the rail terminals you're talking about? And can you help us understand what is the timeline we're looking at? And what is the current status? Has the land been identified, acquired? And if you could elaborate a little bit on the location.
So 250 crores is for all capex going forward. This is warehouses, equipment, and both ICDs. And this is only primarily for the rail business. I mean, out of the 250, maybe 10 or 15 crores will be required for the CFS business. Timeline-wise, this is the capex for the next 2 years that we've said. And we're in the middle of identifying, we have identified the land, so we're just looking how to finalize it, and hopefully we should be able to close it within the next quarter.
And these will be on the DFC route, or they are the satellite terminals as we earlier indicated?
It will be on DFC as well as, on our hub and spoke model. So, everything cannot be on DFC. So the northern hinterland is so vast, and where, the volumes is there, are there, and business is there. So, it will be on DFC as well as other parts of the hinterland.
Understood. And you also mentioned that there will be equipment or capacity enhancement in the existing locations as well for the ICDs. Can you elaborate a bit on that? Which location and what extent the expansion are we looking at?
Yes, we have 4 ICDs now, 2 in NCR, ICD Garhi and ICD Faridabad, and then we have one in the northern part, which is ICD Ludhiana, Sanewan. And then we have one in Viramgam. So all these places where we have land bank and we have the ecosystem and the infrastructure, to serve the existing volume plus another, say, 25 to 30% volume. So as and when the volumes grow, our present volumes in NCR would be about 250,000 TEUs or something like that. Including Ludhiana, I think we are close to 25,000 or even more on the 25,000 TEUs, you can say. So our capacity, as I said, the ecosystem is there, the locations are there, and any increase because of the volumes going up, both on exim trade as well as containerization from bulk to containers, and the market share, we can go up to easily 4 times this volume, 1.2 million TEUs with the minimum CapEx. So that is where we are allocating some funds to, have the equipment, pave the area, have some additional warehouse, but the land bank is good enough to, take care of that. So the CapEx on that will be very small, but the main CapEx will be on the 2 main terminals where we are working on it, and we will be finalizing soon. And those are the ones where the main CapEx will go. And ultimately, when new terminals come up, everything has to be done according to our standards, because Gateway Distriparks right from the beginning has different standards of quality of construction, quality of services, and that means the cost and also the IT system, which is required for customer enterprise and even for the line. So mainly our investments are going in that direction, and 250 crores is on a conservative way that we have quoted now. It might be even higher.
And the timeline for this?
Timeline for this, Samit said 2 years, but I'm quite hopeful that in the next 12 to 18 months we'll be spending this money.
Understood. My second question was with respect to...
Even earlier, Achal, just to answer your question, we are looking for some land acquisition. We are looking for existing operator acquisition, which are now available quite a lot. There is a distress in some of the rail operators who are not able to run properly, or they're at a standstill. So there are acquisition proposals, which if it happens, it can happen say in 4 weeks or 8 weeks also.
Sorry, I'm a bit confused. So are you talking about these 2 terminals could be through acquisition or could be greenfield? Is that understanding right?
No, these 2 terminals, one will be acquisition, one will be greenfield, and there are other opportunities also which are there in the system. In the container train operators, there are so many operators, and not everyone is running well, or so they want to exit this business, and we'll look at it. We will judiciously take a call. Whether we are whether that location and that business is worth taking over or not.
Got it. And second question was with respect to synergy. You said now it's fully integrated. Possible to now talk about what kind of synergies can we expect in terms of quantification on a quarterly basis or a full yearly basis? What kind of savings or incremental profits we can look at now, just purely from the synergy perspective?
Yes, savings are coming in, month by month, because there's a lean organization. There's as I said, there is a comes up in the cash flow. So it was already accounted for, or provisions were made. So there is nothing in the P&L account. It is only a cash flow matter where there was a big expense in Q1 of this year, but going forward that expense will not be there.
Understood. And just last question.
The debt levels, overall net debt levels will remain within, say, 1:1 EBITDA is what we're targeting. So we're not going to over-leverage ourselves for this new terminals and everything.
In fact, we are below 1:1. So, like I said, Q1 saw some exceptional, not exceptional, I would say, it was provided for, but it was paid in this quarter, like the dividend asset and the employee benefit. Which include the variable pay and some bonuses and directors' commission and everything, which is not going to be there, for the next 3 quarters. So all these will help us in the cash flows, and those cash flows are going to be utilized to reduce the debt and fund our new acquisition, because this 200-250 crores, 50% will be coming from our own accruals, cash accruals, 50% will be new debt, but at the same time, the old debts will be retired by that time.
Got it. And with respect to, since now CFS and rail volumes are combined, we don't have a breakup, does that mean that overall aggregate volume growth could be 5-6%? And how do we look at the margins at a consolidated level? Do we see a substantial improvement from here on over the next couple of years, or you think it will be more gradual improvement?
So this volume is without any addition of capacity or the new terminal amount. So yeah, I'd say that's about a fair assessment. Say 6-7% we can look at for growth in volume. EBITDA per TEU right now, how it's between 5,000 to 5,100. It'll change a bit, but yes, it will improve going forward. As we increase our volume, this will improve as well.
Understood. That's helpful. Thank you. I'll come back in the queue. Thank you.
Thanks.
Thank you. Before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. Next question is from the line of Krupashankar NJ from Spark Capital. Please go ahead, sir.
Good evening and thank you for the opportunity. Just a couple of questions from my side. First, on the DFC side. So you did mention that the progress is ongoing. Can you give some color on what is the current status and what are the further opportunities with respect to operating leverage, which will drive margin expansion because of DFC? If you can highlight on that. Hello?
Sachin here. Krupashankar, this is Sachin.
Yes, sir.
If you look at classical operating leverage, this business does not have classical operating leverage because we have high fixed cost, high variable cost business model as far as the rail business is concerned. So the essential advantage can you hear me?
Yes, sir, I can hear you.
Yeah, so the essential advantage of dedicated freight corridor comes in 3 ways, out of which 2 aspects are available to us. Dedicated freight corridor runs heavier trains, faster trains, and longer trains. Longer trains is an advantage which is available only to Indian Railways because then unit cost of operation of a train gets reduced. That benefit is not passed on to rail operator. As far as heavier trains and faster trains are concerned, turnaround improves. So productivity per train improves on account of that. This also results into regularity of frequency of service that attracts more customers. So the addressable market increases on account of that. And because of the heavier trains, it is possible to do higher double stacking, which is basically a cost-saving benefit which accrues to the company. So these two things will continue to intensify. So currently, let's say dedicated freight corridor with 23 tons of axle load per wagon, and so roughly let us say about 81 tons of gross load and payload of about 68 tons is able to give us a certain level of cost savings on account of double stacking. This will intensify further once we get the new type of wagon, which is 25-ton axle load wagon, which can run at 100 kilometers per hour. Current 25-ton axle load wagon is allowed to run at 100 kilometers per hour only on DFC. The rest of the Indian Railway network, it is allowed to carry 23 tons, not full 25 tons, and is allowed to carry travel at 65 kilometers per hour. Once these constraints fall off, and 25 tons axle load on the entire network, on the feeder network as well as on the dedicated freight corridor network becomes available, the advantage will further intensify. So this is not exactly the classical operating leverage, but the true operating leverage in the transportation business will arise out of this. And the margin expansion will take place on account of this. Currently, we are at about 5,100 rupees, 5,086 to be precise, as far as our EBITDA per TEU is concerned. And the margin would be to take it closer to 5,500.
Understood, sir. So, what would be the current status? As in, what is lacking behind given that the existing connectivity to Mundra and Pipavav is already completed? So, and given that northern hinterland volumes predominantly go to these two ports, what can come in incrementally is my question. On these two ports, at least.
Okay, so see the mechanism of attracting more volumes is by way of organic growth as well as modal shift. And the organic growth primarily is driven by the economy rather than by transportation, because transportation comprises a very small part of the overall scheme of things, or let's say a cost element. Unless Indian products are attractive internationally, Indian export will not increase, which is what has started happening since last year. You must have noticed the growth that we have had as far as merchandise export out of India is concerned. This trend will continue, and that will result into additional business coming to the overall basket. And within that basket, on account of dedicated freight corridor, the rail product has become significantly superior to the road product, resulting into business moving out of Mundra Port and Pipavav Port, particularly Mundra Port CFSs, and then getting converted into road in import direction, as well as in export direction, cargo going to Mundra Port CFSs by road, and then getting converted into containerization over a period of time will shift into ICD. We can very clearly see this trend. It is evident in the numbers that we are posting as well, that overall volumes are intensifying as far as ICD business is concerned. This is something which is going to grow over a period of time, and it is good performance, good let's say service delivery by rail sector will result into intensification of volume. Intensification of volume will result into shift of volume from pure road only to rail, by road and rail. That is a multimodal, and this is what is likely to play out over a period of next 3 to 5 years. Currently, let us say we are operational only from Ateli to Karjoda, which is let's say Rewari to Palanpur section. Not fully operational, but more or less, I think we are there. We are also likely to reach to Mehsana and to Makarpura, which is appropriate the capital which is available with us to rail side capacity, it makes much more sense to put it into development of terminals. And that's what gives you, let's say, a stronghold in the market in terms of deeper penetration as well as addressing higher volume of containerized traffic in EXIM business.
Thank you, sir. That's very helpful. That's it from my side. Thank you and all the best.
Thanks.
Thank you. Next question is from the line of Yash Tanna from iThought PMS. Please go ahead.
Yeah, congratulations on a good set of numbers. I just wanted to ask, could I have the ICD-wise capacity utilization breakup for the rail terminal? Hello?
Yeah, sorry, it was on mute. So unfortunately, we're not sharing ICD-wise data. But as a general rule of the overall ICD business, we have land bank enough to take it 4 times to our current volume. Based on the existing capacity, we're utilizing 50%, roughly 50 to 60%.
This is a combined.
So yeah, basically we can double our throughput on the existing capacity, and we can make it 4 times our throughput with incremental capex on the existing land bank of our ICDs.
Okay, got it. That's helpful. And also, like qualitatively, can you highlight which ICD terminals might be, on a very high utilization? So we need to expand there. As you said, we are expanding the current ICDs as well.
Yeah, so Garhi is our flagship terminal, and that's where the major volume will be coming. And since that's a hub also, we would need extra capacity over there to handle more containers, as it's a hub in the north, and all containers will go from there to the west.
Got it. So Garhi is installed capacity is 2.5 lakh TEUs, right? And we can go up to 4x with some capex.
Yeah.
Okay, got it. That's helpful. Thank you.
Thank you. Next question is on the line of Sumit Kishore from Axis Capital. Please go ahead.
Hi, good evening. 2 questions from my side. Could you please talk about the EBITDA margin decline that we've seen on a year-on-year basis? So it seems that at the realization level and top.
Sumit, you are both not audible as well as comprehensible. So probably you could be a little closer to the mic, and if there is a noise around you, if you can avoid that, that will help.
Am I audible now?
Yeah, better.
Yeah. I have 2 questions. The first question is on the EBITDA margins. So we see a decline of close to 150 basis points on a year-on-year basis. And that is despite, the throughput growth at the consolidated level, and the total income growth seems to be of a similar magnitude, close to 4.4%, 4.5%. So what is leading to this EBITDA margin decline? If you could break that EBITDA margin decline into gross margin and the other expenses, and talk a bit about the pressures there. The second question is on the tax rate. So there has been some tax adjustment, it appears, tax write back, which is leading to higher profit growth, although the performance at PBT level is a lot lower. So, could you speak about the full year tax rate and what exactly has gone into the taxes in this quarter?
No, you see, the decline in EBITDA which you are talking is on the combined volumes and throughput. And since we are adding the empty, handling at the CFS level, so our volumes are higher. And these are reflecting in the volumes. And so going forward, you will see that this is one time, CFS empty, and then also one-time merger cost, and also the increased ISC which we could not pass on to the customer, because there is always a lead time giving a notice to the customers, which varies from 30 to 60 days. So we have been able to this rollback by the railways of 5% discount was on 30th of April. So during the month of June, we have been able to get back some revenues which are going to the bottom line, and also at the same time, something will come in July also, which is Q2. So going forward, you will see that the comparison will be a very fair comparison between the overall volume and the overall revenue and the EBITDA margin and the EBITDA and net PBT and everything. You will see a change in that. So why we are not giving these item-wise, rail vertical or rail location-wise and the CFS location-wise is because it is very sensitive to give this information. And the idea of merger was to have one company, one financials. If one company has to divide into different verticals, because we might go into some other activity now, which is warehousing, which is in big demand, which will be in our ICDs, which will be in our CFS. We are expanding the warehousing over there, but the customers are asking for warehousing outside the CFS or ICD. The volumes will be linked to the service that we provide with the warehouse and even going to extended service levels, scope of services. So I think the EBITDA this quarter, you can see what it is, and to be fair, the comparison will be next quarter.
So what is the one-off element in this quarter which is depressing your EBITDA? What is the quantum if you were to look at it just with the EBITDA numbers?
Say it's about 2.5 crores. These are basically legal fees, merger expenses and all.
See, these one time can be quantified, whether it was on the merger, whether it was on the CFS or whether it was on the... So as I said earlier, it will be a fair thing to compare our Q1 results with Q2, where every parameter will be tested.
So just one comment here. If you're not going to share any segmental information on CFS, ICD, at least provide some color on transportation income or storage income or something of the sort that gives more color into what the company has achieved in a certain quarter. Otherwise, we're just looking at some headline numbers and trying to understand your commentary, which frankly is not making as much sense as it used to.
No, I'm sorry to say that then you are not understanding the process which has taken place over the last 2 years, or you have not been following the company, because we cannot give you segment-wise what is happening, because similarly we cannot give you the cost of the management. We were having overheads at each and every location, in each and every vertical. What we are planning to do and what we will achieve, it is for everyone to see. What we are talking now is our Q1 results, what are the adjustments in the Q1 merger cost because of the RSC by Indian Railways, because of the CFMT thing, and more than that, we cannot give you a color on what will be the. It will be forward-looking statement that we are saying that look at this quarter, this has happened, but it will not happen in Q2. It will not happen in Q3. So,
okay.
To be fair to us also, these questions should be limited to what exactly we are doing and what exactly has happened. And if you have followed the company for the last couple of years when the merger process was announced, you should be able to analyze what is there,
Mm-hmm. Yeah, so would it be then fair to expect going forward some color on, so I understand there is rail by ICD and CFS stream underlying. So there is an element of transportation income, and there is an element of associated with whatever handling you do of the containers at the ICDs. So or some other handling income at the CFS, if at all. So would you sort of break it up into this handling and transportation income so that we get some more color?
Hi, Sumit, Ishan here. So even in the past, our breakup of revenue which we collect from customers varies based on location, based on activity which we perform. And it's not a segment which we track in the financials because these are consolidated agreements that we have with people for carrying out a number of activities. So that's why we don't bill in that sense that handling is separate, transportation is separate, and warehousing is separate always. It depends customer to customer. The way that that you should be looking at it, how we also look at it as promoters, is the volumes that we are doing, how much we are seeing in each of our locations, each of our geographies which we operate in. That's what we are worried about. Import and export is what we are looking at, not domestic, and it's end-to-end pricing for the customers.
Thanks, Ishan. I appreciate that. My last question is on the tax treatment which has happened in this quarter, and what kind of a tax rate should we take for the residual year?
Yeah, Smith Sandeep here. The tax rate which we have taken for this quarter is MAT, that is 17.47%, and the current tax which we see our financials of 9.14 crore is the MAT tax rate for the current quarter, and there is some reversal of deferred tax liability of 13.27 crore. That's why overall tax expense is coming 4 crore negative. And for the full year, we will keep on paying MAT for the full year for this year. It is 17.47%.
Thanks, Sandeep. Thank you so much for answering my questions.
Thank you. Next question is on the line of Atul Tiwari from Citi. Please go ahead.
Yeah, so just would like to get some sense from you about the transit times on DFC, to Mundra Port and Pipavav Port as of now, and how does it compare with when the first leg was not commissioned? So that is one part, and are you seeing some kind of shift from rail to road to rail already, or that is yet to start? Hello.
So the pre-DFC turnaround time or one-way transit time used to be of the order of about a mean of about 60 hours, with maximum can be anywhere between 100 hours to sometimes even worse than that. But our average transit time in export direction has now settled somewhere around 35 hours for Mundra Port, about 42 hours for Pipavav Port, and is roughly about 40 hours as far as Nhava Sheva is concerned. But this is the mean time. There are cases in which there are a large number of cases where the transit time is in fact coming down. We have had a best ever time of 27 hours as far as export movement is concerned. Import direction, the numbers are still a little on the side, roughly about 2 to 3 hours more than the export direction. But as we get advantage of the feeder routes between Mundra Port and Palanpur, as well as Pipavav Port and Viramgam, getting converted into DFC standard route, this is likely to come down and settle somewhere around 24 hours in either direction. The Nhava Sheva benefit will come when Sanand Makarpura, Sanand Badodara Nhava Sheva link of the dedicated freight corridor, which is phase 2 and phase 3, will get commissioned. That is the time when we will also see Nhava Sheva transit times somewhere around 24 to 28 hours. There has been a significant drop in the overall transit time that has resulted into volumetric growth for the ICD business, and within the ICD business, our growth has been much more spectacular as compared to other operators who either are not necessarily directly serving on the dedicated freight corridor or do not have the network effect which we have on account of having multiple terminals being operated through a hub called Gadiyar Servo. As mentioned earlier on the call, our intensification of our penetration in the market is going to be by way of development of satellite terminals and maybe a couple of terminals which are closer to the dedicated freight corridor. This benefit is further likely to intensify. So this is basically the overall operating strategy, that you address more and more market, closer to the market, go into areas where it is either unserviced or underserviced, pick up business from there, bring it to a hub, transport it on heavy duty, high speed trains between hub to hub or hub to port, and contain your unit cost of production to such a level that you are able to generate margins which are better than the industry margin. The price will continue to be determined by the play of demand and supply. So whatever price discovery takes place on the street, vis-a-vis that, if you are able to manage your cost metrics well, then you will be able to make money at the same time provide quality of service. So on this mantra, I think we have been able to deliver in the past and will continue to work further going forward as well. And modal shift, which was evident during the initial commissioning of dedicated freight corridor, whether it was half of it when it got commissioned in January 2021, or full commissioning which has taken place somewhere around April, May 2022, will further intensify. I think the numbers are going to speak for themselves going forward.
Okay, sir. Thank you. Thanks a lot.
Yeah.
Thank you. Next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question, and I hope I'm audible. Just a query on the, now the merger is through and we are seeing a change in the reporting structure, at least for the analysts. But in terms of executive structure, how is the executive structure like? Is there is it still sort of separate leadership looking at rails and CFS as a separate business, or is it merged structure at the top? Hello?
Yeah. We are still in the process, and most of the management team has merged. So I don't understand what are you talking about, the merged management, or obviously the rail business has a different set of people, and the CFS business has a different set of people. But earlier, like when we were having two CFOs or two different sales people, and so it's a very lean organization now. And it has definitely resulted in the cost that we have been able to achieve over the period of the last 12 months. And when the merger was announced in December, when we got the permission from the NCLT, and by the time now that we are speaking, it is still an ongoing process, and definitely it will be a single lean team where there will be no duplication of work.
Yeah, and just to understand in terms of business or MIS or data capture, do each of these terminals, be it CFS, ICT, they maintain their own PNL, or there is a centralized or the business-wise PNL is somewhere else? I mean that category or that SB would be somewhere else.
Look, so each location has to maintain its own profitability, otherwise we won't know what we're doing. So I think it's quite obvious that that would be maintained, and then it's all centralized and we give the consolidated number out.
Okay, and the volumes that you report is essentially addition of the volumes that each terminal is handling, right? I mean that's the way to look at it. I mean, be it CFS or ICT. So
look at, let me be very clear that the lean and single organization is there, and this is an internal process where we watch each and every location, not vertical, whether it is CFS or ICT or warehousing or any other. We have associate company also, there also, GDL board is involved in it. We have a 60% ownership in Gateway Kerala, where we are fully involved into the running of and the reporting of the numbers and the profitability. So if you ask us, how much one person is getting paid off, and these are not nitty-gritties. I mean, I think since this is the first quarter that we are making a big change, you are having all these questions. But I mean, I'm sure you are watching or covering other companies also. Gateway Distriparks is one company, and it will continue to be one company, and the expansion there, whether we acquire something or whether we build up a new thing, it will be GDL, one consolidated company, one board, and one management. And please don't go into these nitty-gritties of, how we handle the people, how we handle the customers. It is an internal process. We have a business which we have to conduct, and you should be happy that we are conducting this business in a positive manner. And the growth chart, I mean, I don't want to project it right now, but definitely we are on a high growth path.
Sure. That's helpful. The other question which I had is that in terms of acquisition, you said, the possibilities of acquisitions are there. So which catchment areas are you looking at?
It will be in the northern hinterland because, the rail business is profitable only if it is more than 500 kilometers from the ports or, So we have one or two locations in mind which are less than 500 kilometers from the ports, but we will be, working on a hub and spoke model where, each and every location on its own has their own volumes, and they give us the profitability to the company.
Got it. That's all from my side. Thanks.
Thank you.
Thank you. Next question is on the line of Harsh Shah from Jefferies. Please go ahead.
Yeah, hi. Thank you. Actually, my question has been answered. Thank you.
Thank you. Next question is on the line of Ria from Equitas Investments. Please go ahead.
Hello. Thank you, sir. I just wanted to know when will DFC be fully commissioned, and what kind of incremental volume growth are we seeing from there? And second question will be in regards to the overall charges which we could not.
We are not audible. You are not audible. We can't comprehend what you're saying. I think there's some problem at your end. There's a little echo as well as yeah.
Can you hear me now?
Yeah, it's better, much better.
Hello. Sir, can you hear me?
Yeah.
So my first question was in regard to the DFC which is getting commissioned. So what kind of incremental volume do we look at from that aspect?
We are already having incremental volumes on the DFC, and as and when there was some section maybe last week when some section has been tried, so that will add another 100 kilometers. So each and every section gives us an improved turnaround time, and that helps in getting the business shifted from road to rail. And the other thing is that our locations are, we took a call early, and our locations are much better than other locations, which our peers have. So I think the incremental volume is coming every month, every quarter, and by the increase in the total DFC corridor, which Sachin just mentioned will be completed by end of this financial year to Pipavav and Mundra. But Nhava Sheva will take time, maybe another year from the completion of these two sectors. So DFC is definitely helping us in increasing our volumes.
Okay. In terms of percentage, could you help us? Like, what would be the incremental throughput coming from there?
Sachin, how much percentage we are gaining every quarter with the DFC because of the DFC?
So the growth in the market on account of DFC is currently pegged somewhere around 12.5%. But the overall intensification, and that includes both the movement from the modal shift from road by road to CFS to ICD by rail. This includes some element of organic growth and some element of modal shift. The expectation is that it should be in higher teens. But I think it will take some time for that to happen until the dedicated freight corridor reaches Nhava Sheva, which is a much richer, I would say, container environment in India, multimodal environment in India as compared to only the Gujarat port, because Gujarat port also have to compete with the Kandla port environment for bulk cargo transportation. So once it reaches Nhava Sheva, it will get further intensified. I won't be surprised if we have modal shift as well as the organic growth in this sector upwards of 20%. But it is going to unfold over a period of next 3 to 5 years. We'll have to wait for that. And we are working towards it as far as our operating strategy is concerned, which I just now mentioned in one of my answers to an earlier question.
Right. I think that was very nicely summarized by you. And currently, we, as you mentioned, that we are at 50% of the capacity of our ICD business. So going forward in like next 1 year perspective, not from a long-term perspective, what kind of capacity utilization are we looking at?
If you go through the investor presentation, we have the installed and design capacity over there. So we're currently at 50%, and with the volume growth that we've given on this call, you can kind of assume where we'll be exactly.
Okay, so 6 to 7% is your volume guidance for the next year, right?
That's for the company as a whole.
Okay, and for ICD business specifically?
We're again not splitting between CFS and ICD, so we're just giving a throughput for the whole company now.
Okay. Thank you. That's it from my end.
Thank you very much, ladies and gentlemen. That was the last question for today. Participants have missed out due to time constraints. They can reach out to the management and SGA. On behalf of Gateway Distriparks Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.